Budget. But let's quickly welcome in Mayuresh Joshi as well, fund manager at Angel Broking. Good afternoon, Mayuresh. Firstly, wishing you a happy new year. Firstly, to start off with, in terms of where markets go, as Pranoy was also mentioning right now, that we are seeing a lot of consolidation that's happening. Do you think that, ahead of the budget, we could see some bit of a pre-budget rally that could come in? We could break resistance levels of 10,550 and inch towards the 10,700 or 10,800 mark?
Afternoon, Hiral. A very happy new year to you, Pranoy, the entire team at BTVi. I'm wishing all the investors a very prosperous one as well. So largely, again, I think if you look at the expectations from a pre-budget rally, I think a large portion is supposedly expected to be expended, at least from the exchequer side, into key areas which will have focus on rural and rural aided schemes. Apart from that, I think the normalized expenditure that is expected to come through for infrastructure, roads, ports, affordable housing can very well continue. So the possibility of a pre-budget rally is not ruled out, but my own expectations over the next few weeks is a very constrained range for the Nifty or the index to probably trade in. So I think it's a 400 kind of a band that Nifty can actually trade through, maybe 10,300 to around 10,700 levels.
Right. Mayuresh, we'll come back to you. Let's put the focus on Reliance first. That has been the counter in focus with the initial gains of almost 2%, now a little lower. This after the company has commissioned its ROGC facility in the Jamnagar complex. CLSA, in fact, has a bullish call on the counter. They're expecting the recently concluded CapEx exercise to result in monetization incrementally as well for the core business. Piyush Jain joins us with more details about what CLSA has to make. Piyush?
Well, CLSA actually has a buy rating, so basically they have a bullish stance on Reliance Industries stock here. What actually they are saying that the commissioning now of ROGC projects, actually it implies that almost $40 billion of projects now actually move to the monetization stage here, which also implies that while actually you're going to see fall in capex for financial year 2019, it will also basically mean that as the utilization of these assets that actually goes on increasing, the cash flows actually are going to increase, which also means the return on invested capital that actually is going to increase, which all bodes well for the investors here. They actually are saying that now these assets are right into play, but now what basically is the hidden value is that Jio has almost 15 crore plus customers, whereas Reliance Retail has only 1.5 crore customers. So they believe that now actually the next stage of monetization would be the cross-selling of products, or cross-selling basically could be the next opportunity for Reliance Industries between its different sort of businesses here. Also what they're saying is that in terms of telecom networks, the next catalyst to watch out for the stock would be the launch of FTTH or the broadband business here, then the launch of enterprise solutions, and number 3 would be the ramp up of the feature phones. As we know, Jio actually has very high target in terms of feature phone users, so again the ramp up of that again would also be the next trigger here. And lastly again is they believe that as basically Jio goes on increasing the tariffs or normalizing the tariffs, the ARPUs are going to increase for the smartphone users also. So again, all those 4 are going to serve as catalysts, but the real silver line from CLSA is coming is that market is not actually understanding right now in terms of what opportunity lies for cross-selling, or what value could come from the cross-selling for Reliance Industries stock here.
All right, thanks so much for getting us those details, Piyush. Mayuresh, your thoughts on Reliance and what's the long-term target that you're working with?
So again, remain very, very positive over the next 1.5 to 2 years for the stock. And a clear disclaimer, we do hold this stock in our funds. I think the basic premise that Piyush was enumerating, I think holds true. But a large element is that their core businesses will start performing exceedingly well. So I think with the 2 new capacities, the refining of gas cracker and the expectations of the petro gasification coming through, a large part of the capex which was deployed in these assets on the core side should start delivering results as the sweating of these assets start happening more effectively. Second, again, I think in terms of ethane being sourced and that probably replacing or substituting the high raw material costs currently used is going to incrementally add to the EBITDA as well of the core business. And on the telecom front, again, I think you're probably looking at a large part of the capex probably behind it. And with ARPUs being a lot more better than the existing incumbents, at least at this point of time, with expectations of monetizations across the value chain, as far as the subscribers are concerned, you're probably looking at cash flows increasing. So on a consolidated basis, the ROE is we were probably constrained for all the reasons related to capex, in terms of cash flows, in terms of incremental cash flows not coming through, should start emanating for Reliance. So I think remain extremely positive on this stock, Pranay, over the next 1.5 to 2 years.
Saga,
Right,
Andhra.
so that's in terms of Reliance Industries. Over the last 1 year, almost 69% is the upside that we have seen on the counter as we speak. And in today's day of trade as well, 920 is the level that counter is trading at, with gains of almost 1% coming in there. But moving from this space, let's quickly look at the cement space as well. We have Saga Cement. That counter is shot up after Ventura Securities has given a big bull call on the stock, and they're seeing almost 89% upside ahead for the counter. In fact, Raj Mehta brings us the details of that report. Raj, basically what is Ventura actually betting big on, because not only Sagar, but we have other counters also that have started to move upwards now.
So we have Ventura and Saga Cements, and they've initiated a buy rating in the stock with a target price of 1715. They believe that there is strong revenue growth ahead, given that volumes are expected to grow around by 19%. They have also built in an average realization growth of around 9% for the next 3 years. Ventura believes that the company has a diversified geographical sales mix, and currently the company sells around 54% of its volumes in Andhra Pradesh and Telangana. Going forward, is expected to increase its sales in Orissa, which is currently at 4% levels, because of the additional capacity in Vizag. Ventura also believes that strategic capacity expansions and cost savings will help lower freight costs and also boost EBITDA per ton. Capacity is expected to scale to around 6 megatons by FY20, and also EBITDA per ton is expected to grow around by 20%. It is expected to grow to 834 tons per ton by FY20 from current 481 per ton. Overall, they believe that improving operating cash flow and also revenue visibility will help lower debt, and EBITDA is expected to grow around by 43%, whereas PAT is expected to reverse from a loss figure of 4 crores to a profit figure of 157 crores by FY20. So seeing the improved revenue profitability and visibility of sales and the diversified geographical sales mix, they believe the stocks needs a re-rating, which is why they've given a target price of 1715, which is implying upside of 89%.
So an upside of almost 89% in terms of as Sagar Cement is concerned. But apart from that, you have other smaller names also that are moving really well. So you have the likes of Shree Cement, which is up in trade. You have Sangi Industries also, which is doing pretty well. Ramco Cements, Prism Cement, all of these counters are seeing a strong up move in today's day of trade. Mayuresh, I will come to you in terms of where all these mid-cap cement counters are concerned. We are seeing a bump up that's coming in. Execution has started to come in terms of where the infra space is concerned. A lot of positivity that's coming in the infra space. What would your call be, leaving aside the large cap counters, any of these mid cap or small cap cement counters that you would prefer?
So again, as a space, I think they should keep on doing well here, but I think the constraints that they might face because of sand mining issues and because of increase in petcoke costs is going to weigh in on their margins, at least for the next 1 or 2 quarters. Having said that, as demand comes back gradually and as utilization levels start picking up, the return on capital employed and EBITDA per ton basis should also start improving. So both these parameters should start showing significant improvements. Having said that, I think for the mid-cap universe, Ramco Cements is something that I've continued to like. They have added capacity and they're expected to add capacity over the next few years. And again, I think the kind of issues that I've mentioned that we're facing, their south-based operations, I think they should slowly and steadily start getting over that. And the improvement both in terms of the e-way bill implementation as well as lesser warehousing required in terms of interstate transportation of goods is going to affect these players as well. So I think Ramco is something that I continue liking. JK Cement, because of the white cement play and the realizations being far better than grey cement realizations at this point of time, should hold the stock in good stead because of the consolidated uptick in the revenues that one can witness on a compounded basis over the next few years. And JK Cement, both in terms of expectations of realizations growth, as well as a lot of cost optimization programs that they have run at their Tur plant. So the conveyor belt or the captive power plant that they've probably put through along with the valuations, I think it falls in the lowest quartile in terms of an EV to ton base of almost 85, 90 odd dollars per ton. So I think these three stocks is something that I'll continue to pursue, I think. And as a bag, I think you should probably be buying this as a mix rather than concentrating on one particular company at this point of time.
All right, let's put the focus on metal stocks as well. Pull up the BSE Metals Index first, because the steel names are doing better in trade today. So names like JSPL, JSW Steel, and even Tata Steel to an extent are the better gainers if you compare them to the non-ferrous names. JSPL is up a good 5.6%. Tata Steel is up a little lower, but JSW Steel is the one that we are speaking about. Goldman Sachs has come up with a report on the counter. They've increased their target price to 315, and they have initiated a buy rating on the counter. Essentially, they believe that weaker raw material prices globally, as well as lower cost captive raw material and iron ore are the beneficial triggers in terms of earnings upside going forward. More details with Bhaskar from our research team, who joins in with exactly that. Bhaskar?
Well, yes, we have Goldman Sachs on JSW Steel, and they have initiated a buy rating with a target price of 315, implying an upside of almost 16%. They say that the company has no raw material integration and is well placed to benefit from the weaker global raw material prices, and say that the captive mines will also lead to lower iron ore costs. The brokerage expects higher capacity utilization at the industry level and indicate an increase in the proportion of sales to the domestic markets. In terms of capital expenditure plans of the company, the brokerage is saying that it will help enhance the steel capacity by almost 5 million tons by the end of FY20, and expect value-added sales to increase from 32% in FY18 to 36% in FY20. The brokerage also sees that the company will be slightly free cash flow negative in FY18, but expected to generate strong free cash flows over FY19 and FY20. Cost savings initiatives like the pipe conveyor system for the iron ore transportation, commissioning of the blast furnace, and digitization should help cushion margins in the medium term, and expect margins to increase from 22% in FY17 to 25% by FY20. Overall, they value the stock at 7 times the EV EBITDA, while it trades at 6.2 times, and that's why they have given a buy rating to the stock with a target price of 315. Back to you.
Thanks for those details, Bhaskar. Mayuresh, coming back to you, your call, and if you can segregate your view between ferrous and non-ferrous players, are we likely to see the continued strong run that we've seen on industrial metals on the LME? So thereby, what's your view on names like Hindalco, Vedanta, Hindustan Copper, Nalco, and other names in that list? Plus, what's your top pick in the steel space?
I think, so Pranav, the good time should probably continue, because if you're looking at the kind of Chinese imports that are taking place, more or less to do with the winter stocking process, will have a good say in terms of both Q3 and Q4 numbers for both ferrous as well as a lot of non-ferrous guys as well. Having said that, I think you've probably seen alumina prices shoot up significantly, and because of the demand-supply constraints, I think across the metals chain, when you talk about aluminium, you're talking about copper, and the end realizations when you talk about HRC as well as the cold rolled cooling steel prices, they have been seeing an up move. So a large element is how they are probably able to offset their cost in terms of putting it through in terms of realization increases as well. And because volumes are sustaining, at least for the domestic players, I think the sustainability in terms of earnings, at least for the next two quarters, not ruled out. Vedanta, for example, the zinc business, which contributes 56% to its EBIT, and the zinc price increases that we've seen, is going to affect both its top line and the direct pass-through in terms of the leverage being played on the bottom line. Similarly, it will hold good for Hindustan Zinc because of the significant increases in terms of FOB prices on alumina, as we've seen from a couple of steel players and aluminium players on their sides. You're probably looking at Nalco probably carrying on its good show for Q3, Q4. Hindustan Zinc, as I mentioned, should continue doing well as a mix of a lot of the metals play. Probably looking at Hindalco in terms of smelting operations being worked at full utilization levels, actually abetting its entire sweating of acid chain and the overseas operations at Novelis, specifically the auto part doing well. So again, I think Vedanta is something that I'll keep a very positive view on. Hindalco is something that I'll keep a positive view on. And the steel players should do well. So I think JSW Steel, with the capacity increases expected and the expectation of a bit upper ton improving from 7,500 odd levels that reported in Q2 is probably a given. You're probably looking at Tata Steel's new capacity being added at a much lower cost of $730 a ton compared to $1,300 a ton, and that could incrementally add on to the revenues. So yes, I think a clear hold on steel players, but Vedanta and Hindalco probably would still remain a fancy at least for the next 2 quarters.
So steel counters are expected to continue to do well, as Mayuresh is pointing.
Mayuresh, before we let you go, one pocket of trade that's really buzzing over the last 2 sessions is the fertilizer pocket. So be it National Fertilizer, FACT, RCF, Chambal, all these names are gaining by a varying quantum, and very strong gains that we are seeing across the board. We've just had the core sector numbers. The fertilizer number was not as good as maybe steel, cement or refining, but there seems to be some value buying coming ahead of the budget.
Not too sure about value buying because the stocks have probably moved up significantly. So valuations probably not cheap. But again, I think the expectations, as I said, I think if the outlay probably towards rural and the agrarian side of the economy is pretty large in the budget this time around. And again, I think the dual effect of DBT coming through, you're probably seeing some amount of buoyancy because a lot of dues, specifically on the urea front, the subsidies which were not paid off can get cleared off before DBT actually starts coming into force. And that probably reduces a lot of stress on fertilizer company balance sheets. Now with DBT in position, is it a given that working capital constraints will come down? I think one really needs to watch out in terms of the actual implementation and how the entire process will take place. But a large element of the market is of the belief that with greater allocation and with expectations of more schemes being announced and the expectations of a good monsoon that we have witnessed and the expectation thereof that a good monsoon can be probably seen, you're going to see buoyancy probably happening in a lot of these stocks. So Chambal, Coromandel is something that I had preferred in the past, but the run-up has been quite significant. So if somebody is holding these stocks at lower levels can continue holding, but for a fresh investment, one really needs to wait for declines to come through.
So that's in terms of where the fertilizer space is concerned. Probably it could be a sentimental pre-budget rally that we are seeing, in fact, at least in terms of where rural India play is concerned. But thank you, Mayuresh. Thank you for getting us all the trading bets as well as the investor calls for the day going ahead. But we'll quickly slip into a short break.